Pleasant good morning, distinguished ladies and gentlemen. On this very cold morning in Windhoek, I think climate most Namibians have no clue as to how to adjust to. It is fascinating how when you lie in your bed on a Tuesday morning like this and you think, I've got to get out of my bed, I got to shower and get dressed, and especially because we come from this 2 years of working from home, and then you've got to go out there and go to these events. But well done to those of you who are in the room. I think just for being in the room, you deserve a round of applause, which you will give yourself, of course. Special word of welcome also those of you watching us by live stream. We are excited to have you on all the Old Mutual platforms, the YouTube channel, as well as the Facebook platform. And we would like to have as many people engage with us. And of course, you'll also have an opportunity to pose your questions to our very esteemed panel this morning. My name is Hilda Basana Monjebo. I'm assigned to be your Master of Ceremonies here this morning, as well as the moderator for the panel discussion. Some of my time I spent with Orion as a trustee member, and I also have a responsibility as the chairperson for the subcommittee on communications for the Orion Board of Trustees. So I'm excited to be here with you this morning. And just before we start with the official program, we'd like to ask you just to rise in a moment of silence. We are taking cognizance and we're having reflections this morning on really what happened to us as a community, as an economy, as a nation during the time of COVID. And we all know people who would have been in this room this morning who are no longer with us. Colleagues, partners, staff, and family. So if you would just join me in standing just for a quick moment of silence, and then we can proceed with the formal program. Thank you. Thank you very much. You may be seated. Now, the speeches will start. And our very first speaker is Ms. Patty Olivier. Now, the request I have for you simply as the Master of Ceremonies this morning, because it's so cold, one of the things that you do to keep yourself warm is to create some activity. The activity I would like to create, or have you create for yourself this morning, would be to ferociously clap your hands. We haven't used our hands also for the past so long. Remember we became the elbow people, and at one stage we kicked each other as a manner of greeting. And it was just a fascinating time of finding innovative ways to greet each other. So those hands that you've not used except for sanitizing them, those ones we're going to use this morning to clap for these speakers who are coming to address us this morning. It is often said that public speaking is probably one of the worst fears apparently in the world. And I think so, because every time you're supposed to speak, you go through this self-doubt. Can I? Should I? How would I do? Would they laugh at me? Would I perform well? But yeah, as Masters of Ceremonies, we do it consistently. And I'm not sure if you really know that the original word Master of Ceremonies, or at least the original job Master of Ceremonies, Masters of Ceremonies back in the day used to be Masters of Circus. It used to be the guy at the circus directing the elephants and the lions. This morning, I don't have to direct elephants and lions. I can direct people, and make you laugh and hopefully entertain you a bit and have an engaging discussion. Now, my first honor is to introduce you Ms. Patty Olivier. Ms. Olivier is a consummate consulting professional. I met Patty back in the day of NAMCOR. And that was a long time ago, Patty. And she was at that stage in charge of the Human Resource Department. But interestingly, if you read up on Patty, you'll find that she's a HR professional, a corporate consulting professional, combined with a love for sciences. And if you really go far and deep into her past, beyond the days of NAMCOR, you find out that she was actually a teacher at Dr. Lemmer High School in Rehoboth. If you didn't know that, ladies and gentlemen, please welcome Patty Olivier this morning.
Thank you so much, Hilda, for the introduction, and Good morning, ladies and gentlemen. I must say it's quite nice not to have a lot of protocol and then just to say good morning to all of you. You are most welcome. And also for all of you who have live streaming, warm welcome to you as well. The first question that I asked myself is I want to welcome to you to the first Risk Summit, but why a Risk Summit? And I think it is very appropriate because I think COVID, or the COVID pandemic, has shook our foundations to the core. And we never thought that a pandemic can hit us this hard in the modern era of very advanced science, medical technology, treatments. And but we're here, and a lot of our people, as Hilda alluded to, many of our colleagues, many of our friends, families, a few thousand in Namibia passed away. And a larger number of our people are actually disabled. They're still sitting with the aftermath of COVID. So this pandemic came and it completely changed our lives and our approach to life. So the risk that this pandemic has had was unimaginable. And the lasting impact thereof, we must still establish. The question that we ask ourselves now, are we adequately covered when things go horribly wrong? What is the way forward? Have we reached a new level of normal? Therefore, the objective today is to ensure that we as an industry share our knowledge, but also learn from you as the audience to make informed decisions about important aspects that will affect the lives of those members who have or want to have risk benefits to protect them against future adverse events. So I'm asking myself, what is risk? There are so many definitions that can be used to describe this word. The simple meaning we would use here today is as per the Oxford Dictionary: a chance or possibility of danger, loss, injury, or other adverse consequences. Simply put, uncertainty is a certainty. But can we put measures in place to manage or reduce the impact that this uncertainty might have? What happens to the livelihood of a family who loses the breadwinner? What if one gets injured and is unable to work to earn an income before they reach retirement? These scenarios can be mitigated or lightened by having insurance. So what is insurance? This is protection against a possible adverse eventuality. As they say, only two things are guaranteed in life: death and taxes. Both cannot be avoided, but the burden that remains after a death, the inability to continue to work or loss of income, can be managed by having the right insurance cover in place. For employer groups or retirement funds, the same principles apply. Insurance or group risk cover is and can be offered on both approved or unapproved basis. Things such as group life cover, disability, and funeral cover all form part of benefits that can be offered. When offered on a group basis, economies of scale allow for lower rates and serve as good incentives to have as part of a benefit package for employees. The impact of these offerings will be unpacked further by the panel discussion here today to look at things such as tax implications for employers and employees, the treatment of death benefits, and how claims processes work. The next big thing in our lives is the Financial Institutions and Markets Act, famously known as FIMA. FEMA has been on everybody's lips for the last couple of years, even more so for the past 12 months. Despite the recent announcement of the postponement of FEMA, there is plenty to be unpacked and discussed for the understanding of not only industry, but for companies and members and individuals on the ground, since FEMA is certainly coming our way. For example, what would be the impact of moving from approved to unapproved benefits for participating employers? Are there more out there that the man in the street should be aware of? Let's find out from the panel and the experts today in the room. We have a very knowledgeable panel of speakers and industry experts here today who will aim to enlighten us all today about the risk benefits and how FEMA will impact our lives going forward. I'm talking a lot about these things, but the proof is always in the pudding. The benefit of risks, in conclusion, is Old Mutual paid out about $1 billion in claims last year. We honored claims and assisted in settling claims where they were valid claims, but we also tried our best to meet our clients' needs where possible. As an insurer, we are in the business of paying claims, and we pride ourselves in that. And we ensure that the groups or individuals that have cover are taken care of in adverse events. And we could see that with COVID. I believe that all insurers can agree that 2021 was an extremely difficult year and one that really tested the depth of insurers and the promises made to all policyholders. What can I say? Old Mutual has always been a friend in uncertain times, and we are still going strong. Please sit back, enjoy the day with us, participate. We value your presence. Thank you very much, and God bless.
Thank you so much, Patty, and thank you. I love the way you responded to her speech. Really reflecting on, I think you said some very important things, Patty. For me, what stood out was just that statement you made about uncertainty is now certainty. That is quite profound. So let's proceed with the program. Our next presentation or speech will be made by a presenter whose name is Louis. And I will not be introducing Louis. I'd just like to tell you that last week, actually on the same day, we had a oil and gas, we hosted an oil and gas investor trip to Namibia. Some of the work that I do is in the oil and gas field. And during the occasion, I introduced an engineer as a geologist. You should have heard that room. The engineers were upset. So I thought, let me not make the same mistake today. Just now, I introduced Louis as something completely different. So we thought, for the purposes of, just to make sure that we do the right thing, we'll get an actual actuary to introduce a fellow actuary. And that actual actuary to introduce the fellow actuary this morning is none other than Carmen Foster, who obviously is the head of product development and client retention for the corporate segment division at Old Mutual. So Carmen, the actual actuary, will you please come and introduce your fellow actuary?
Thank you, Hilda. To confuse things even more, I'm also a fellow actuary. All right, an in-house joke for actuaries, I'm sure. So good morning, everybody. It is my honor to present Louis Rousseau to you. He's our first speaker this morning. Louis is the segment head of research and analytics at GenRe. He's based at the GenRe office in Cape Town, where, in conjunction with his team, he provides research and analytical support to life insurance clients based in South Africa, the UK, Canada, Australia, and New Zealand. In his spare time, Louis serves as a member of the Continuous Statistical Investigation Committee of the Actuarial Society of South Africa, as well as on the COVID-19 Actuaries Response Group. He's also playing, I'm delighted to announce, a leading role in the assistance that the CSI is providing to the Society of Actuaries of Namibia in producing the first Namibian Assured Lives mortality table. I think that deserves a round of applause. All right. I've been privileged to attend a number of Louis' presentations at various ASA seminars over the years. He has become a recognized COVID-19 expert, not only within South Africa, but also has a global following, as he's frequently invited to do presentations at international events. The most recent of these being a presentation on COVID-19 for the Canadian Institute of Actuaries. So, without much further ado, I welcome Louis to our Risk Summit today and look forward to hearing, along with you, the valuable insights that he will be sharing with us. Please welcome Louis again with a round of applause. I'm really warming you up this morning. Okay. Thanks, Louis.
Thank you, Carmen. Thank you for that lovely introduction. Just waiting for the slides to come up. What was that? I was going to look. Okay. Thank you. I'm going to start off with just I'm going to talk to you today about sort of COVID-19 past, present, and future, really looking at the history of COVID as I've experienced it in South Africa and Namibia mainly, as well as the current situation, and then some speculation as to future trends. But first I'm going to tell you a bit more about my company, GenRe. Now, GenRe is a reinsurance company. So what we do is we insure insurance companies. So for companies like our mutual and other life insurance and short-term or non-life insurers, we do that kind of business. I'm focused on the life and health side. We have a long history. We've been around since 1846, so Cologne Re, and we merged at some point with GenRe over the years, and now we sort of 100% owned by Berkshire Hathaway, and Warren Buffett, as you can see on the right, is our ultimate boss. It's a very strong company financially, but the key thing that I wanted to bring across is we focus on understanding risk. Risk business is what reinsurers do. We're not that big into investments and all sorts of other things. Risk business is where we make our money, and as a sort of a wholesale insurance operation, those margins tend to be quite thin, so we need to be very careful about how we assess and understand morbidity risk. So hopefully that gives you a scene setting of why we're really following this COVID topic in a lot of detail and trying to understand that. So today's talk and sort of overview is going to be about the past, impact of COVID-19 in terms of mortality, the impact of COVID-19 in terms of life insurance, and then looking at the present, where we are now, and what the next couple of years might bring, and then taking further into the future and thinking about what the implications are for risk business in South Africa and Namibia. So what happened in the past? What happened with COVID-19 over the last couple of years? What I've done here is just added COVID-19 cases per million people for Namibia and South Africa on a single chart, just to show you that we had a fairly similar experience between South Africa and Namibia, although Namibia is slightly different in some cases. Both countries, and South Africa is in blue and Namibia in red, both countries had basically 4 or 5 waves of cases. South Africa started off a little bit sooner than Namibia, but the subsequent waves were almost identical in timing between Namibia and South Africa. The third wave, which proved to be quite hectic for the insurance industry in South Africa, was also very severe in Namibia in terms of number of cases, peaking at sort of over 600 cases per million people per day, which was a peak in Namibia, which was relatively worse than the South African population experience as well in that time. In terms of deaths, a very similar picture as well, although here we can see the third wave in Namibia appeared to be particularly severe compared to South Africa's population statistics. You can see the second wave had higher peaks of deaths per million in South Africa than in Namibia, and in Namibia the third wave was particularly severe. And so for South Africa, the fourth wave and fifth wave hardly feature compared to Namibia's fourth wave still features a little bit in that chart. So you can see differences there, but also a very similar pattern in terms of waves. Those were also caused by similar variants. We had the sort of wild type variant, we had the beta variant, and then we had Delta, and then we had Omicron that's sort of currently around and circulating around COVID-19. So in terms of where to next, the other thing that I wanted to focus on is excess deaths. We just looked at deaths, but what we realized in South Africa is that excess deaths is a far better indicator of what is happening in terms of mortality in this pandemic. In South Africa, we've had just over 100,000 reported COVID-19 deaths, but if we look at the excess deaths that has occurred, it's in excess of 300,000 excess deaths. That excess deaths is defined as deaths that had occurred, less deaths we would expect to have occurred under normal course of events. Now, deaths aren't that volatile for over years normally, and therefore it's quite relatively easy to predict what expected deaths would be on a monthly or a weekly basis over a year based on past trends. And what we've seen is that deaths have far exceeded the typical patterns that we'd expect. So in South Africa, that was 326,000 since the start of the pandemic to date. And that represents about 0.5% of the population. Or put differently, more than 1 in 200 people died. So if you knew 200 people, chances are one of them died over this pandemic, which is quite a high number if you think about that. It's really, really significant impact on society, as Patricia highlighted earlier. The majority is thought to be due to COVID. On the left, you can see the excess deaths over time in blue, and then you can see the reported COVID-19 deaths in red, and you can see the excess deaths follow the COVID-19 waves and fairly closely, and especially the first 3 and 4 waves, peaking during when cases were high and when reported COVID deaths were high and dropping then below again. That really indicates to researchers that these excess deaths are really directly related to COVID-19, not necessarily caused by other events. So the researchers think that the majority, something like 90% of these excess deaths are probably directly due to COVID. We can't tell at the moment how many there are because we don't have the cause information available in South Africa as yet, and that's kind of the problem now. Perhaps in the latest wave, we're seeing some differences here emerging, and researchers are still trying to figure out what's happening here, where the excess deaths is remaining high, whereas the reported deaths appear to be dropping significantly. So basically, we have less than 1 in 3 of true COVID-19 deaths being reported in actuality. So that just tells you a picture. Now, I don't know how that translates into Namibia because you have about 4,000 deaths reported to date, but we do not have excess death information or expected versus actual total population that's available for Namibia. So we don't know what the picture is. If your reporting is better than South Africa, maybe it's not as bad, but if it's similar to South Africa, you would probably expect 3 times the actual number of deaths to be COVID-related than what is reported to date. So that's something to note. Now, the life insurance industry, another point to note, sorry, wrong starting off point. Another point of note is that actually over time, we had different severities of the disease as I measure here by sort of crude ratios. This is for South Africa, where we look at the number of admissions. This column represents the number of admissions per the number of cases that we observed in each of the waves. And you can see the earlier waves were hovering at 10 and 20%, but it started to decline a little bit and it's back down to 10% in the more recent waves. The case fatality rate, the number of deaths divided by the number of reported hospital deaths, I should add, divided by the number of cases, has also worsened and then started to improve again. And similarly, what I also calculate is what I call the case excess death ratio, which is the excess deaths divided by the number of cases, has also worsened and then improved. And similarly, our hospital fatality ratios has been fairly high initially. So the number of hospital deaths divided by the number of hospital admissions has also been fairly high recently, but has come down. This to me is indicative of the virus appearing to become less severe, but in reality, the virus has actually probably become much more severe. So what this shows is that we're starting to see the protection effects of previous infection and previous vaccination actually reducing the severity of the disease over time. Again, we see in wave 5 that this number has gone up a little bit here on the excess deaths, so we're still trying to understand what's happening with those excess deaths in the last sort of in 2022 in particular. So that might be a confounding effect there. The impact of excess deaths around the world has also been significantly different. What you see here is sort of the countries in which I work on, and I've covered Australia, Canada, South Africa, and United Kingdom in here, and this is excess deaths in each of those countries. Now, South Africa, you see here where we have these distinctive peaks, and we measuring here in percentage terms, so sort of deviation from expected. So 100% would be, or 0% in this case would be a normal year, and deviation from that would be higher than normal here. You can see the UK did not sort of escape the initial impact of COVID-19, where they had a significant amount of excess deaths initially. Being a connected travel hub, they would always experience something quite quickly, and that had an impact there. South Africa had a more delayed first wave, and then the second and third wave in South Africa was tremendously severe in terms of excess deaths here. What happened, however, for Australia, Canada, and UK, they started receiving vaccines towards the end of 2020 and the early quarters of the early months of 2021, which meant their Delta wave, if you will, didn't feature as much. It was a rise in excess deaths, but not as significant as South Africa. So vaccination really saved them from this significant wave towards that South Africa and Namibia also experienced in terms of Delta. So that's something to bear in mind. Australia, of course, being well isolated, managed to keep their excess deaths quite low, although currently the excess deaths has risen and is higher than South Africa's actually at the moment still. In terms of life insurance, we have data from South Africa prepared by the Actuarial Society. I'm actually involved with the CSI committee that produces these statistics. We have been investigating mortality in South Africa, and we asked life insurers to start submitting their statistics a little bit more regularly, basically on a monthly basis instead of an annual basis, such that we could track excess mortality in the life insurance industry over time. These are for underwritten products. This is not for group risk. These are for underwritten life products that you would take out at companies like Mutual, Sanlam, etc. And what the expected deaths would be is the 100% down here, and the excess is expressed as a percentage. We also plot for reference the population excess death percentage in light blue here. So the red line is the reference level. 100% would be normal or typical deaths we'd expect. The lines above indicate deaths way more than we had expected during that time period. What you see here is that in January, the life insurance industry paid out about 4 months of claims in 1 month, right, for these underwritten products. And that's just in the first month of 2021 alone. In July, that happened again, another 4 months of claims in excess of over sort of in 1 month. So we had 8 months of claims and 2 months of experience there in 2021, and the other months were higher than expected as well. So that really explains to you this tremendous impact that the COVID-19 had on life insurance risk results over this time period. Currently, it's become much more in line with typical trends, but we also have to note that the excess deaths are still quite high, both on population level and insured results are also not really zero yet. These results are because of delayed claims reporting in the report set, so the life insurance claims here aren't complete yet, so it's probably expected to come up a bit in future releases of this data. In terms of January's results, and this includes actual Namibian data as well, it's mainly South African data though. Similar products, also fully underwritten life insurance products. Here the red line represents the experience relative to what we would expect. You can see in 2018-19 it hovers around 100%. And then just to show you that sort of predictability of these numbers, they are really usually varying in quite a tight range around what we'd expect. And then in 2020 and 2021, you can see the 3 peaks of the first, second, and third wave there. And again, relative to the population numbers in blue, you can see that there. You can see my company paid out, essentially again, 4 and 4.5, almost 5 months of claims in just 2 months during 2021, resulting in significant losses for us. And as a wholesaler, our margins are quite tight, right? So that really is equivalent to us. I think over the whole pandemic, we paid out something like 2 times our turnover, essentially, if you will. So our losses were essentially equal to our turnover for the last 2 years, which would indicate to you how significant that impact is on life reinsurers such as ourselves. What you can also see is that the population numbers are significantly below this and the prior chart. You can see the population numbers in percentage terms are significantly below the insured numbers. And that is kind of presented us a little bit of a quandary, trying to figure out what the cause of this is. Why is this happening? And what we did with our numbers, we were able to dig into more detail in terms of how these numbers operate. And we came up with the following slide to conclude in terms of what we thought was driving this difference of experience that we're seeing between insured and the population. And what it really is when we look at the additional mortality experience by various sum assured bands, by various sizes of policies. Usually a larger policy is owned by somebody who's a bit more wealthy, and a smaller sum assured policy is owned by somebody who's perhaps a little bit less wealthy and therefore not as advantaged as somebody who's more wealthy. When we look at the difference in mortality between what we'd expect, so in absolute terms, we can see that the lower sized policy had higher excess mortality in terms of additional mortality that was experienced. So you can see this number is quite high. The blue is a model that I tried to fit to the data. The red is the actual data. You can see that the additional mortality for this lowest sums assured is a lot higher. So people with low sums assured had a lot higher COVID mortality than people with high sums assured on this end. However, when you divide these numbers by the typical expected mortality for people of these sums assured, you get the graph on the left. So this, in percentage terms, is what we're seeing really. And what it's showing us is that even though these lower face amount policies had very high additional mortality, because their underlying mortality is also a lot higher, in percentage terms, it was a much lower impact than the low sums assured. However, in percentage terms, this small addition to high face amount policies actually presented a big impact in percentage terms because the underlying mortality is also a lot lower for these sums assured. This really, in our opinion, drove the results of the life insurance industry being in percentage terms relatively a lot worse than in terms of the additional mortality experience. So the life insurance experienced less additional mortality probably than the population. However, in percentage or relative terms, that additional mortality costs us a lot more due to the underlying mortality being a lot lower. So that's our explanation of why the insurance results in South Africa and probably Namibia is a lot worse than the population results. There are age factors at play as well, but these are sort of controlled for ages in these graphs as well. So unfortunately, for profitability purposes or actual versus expected purposes, the relative numbers make a bigger difference because we are essentially, in terms of profit, measured against what we'd expect, and our premiums are set with reference to what we'd expect in terms of claims. So this is what's driving profitability in the life insurance space. So that's something interesting. Excuse me. In terms of uncertainty and making predictions, I think one of the big lessons we learned during this COVID-19 is the absolute huge amount of uncertainty around COVID-19 and similar features, which is driven a lot by not only the uncertainty around COVID-19, but also the systemic responses that we might have to the disease and how the society might act towards the disease. Now, early on in March 2020 or so, the British press was having a field day with Neil Ferguson's Imperial College of London team, and they had predicted 500,000 deaths due to COVID in the UK. Their prediction, however, was not really an absolute prediction. This is what's going to happen. Their prediction was under the assumption that the UK government didn't do anything, that the population didn't change their behavior, that the government didn't put restrictions in place. They estimated 500,000 deaths. Similar estimates for South Africa ranged from 15 to 200,000 deaths. So the 200,000 was there if South Africa did nothing on COVID-19. And you can see that was actually a realistic prediction for South Africa to some degree because we were unable to do as much as the UK did, and we did not attain vaccines as quickly as the UK did. Also, we were able to delay to spread out deaths such that it didn't become absolute, that the health system didn't completely fail in South Africa, because these numbers for UK also assume that the health system didn't fail, because if they didn't do anything and the health system failed, that number would have been far higher in the UK, and that's perhaps partly the reason why South Africa's numbers are a bit higher. We also developed a developing country, so our mortality rates, these assume similar mortality rates of COVID-19 in the UK and South Africa. Clearly, South African mortality rates would tend to be higher. So they actually got it reasonably right for countries like South Africa. Their prediction for Namibia ranged from 760 to 6,600. Just bear in mind that these predictions were made in March 2020, so fairly good in terms of the ranges. The bottom end of these ranges assumed very severe lockdowns. Essentially, every time the hospital admissions started to rise, you would lock down, and not something that was practically attainable, as well as some sort of treatment being effective, etc. So that's kind of what we did there, but the range of that prediction obviously was very wide as well. So the level of uncertainty around this continues to be high as well in terms of what we're thinking about the future. So I'm going to talk about the present and the immediate future now. I want you to keep in mind that the uncertainty around COVID-19 and how we respond to it remains quite high, and therefore what I'm talking around next is really around sort of a little bit of speculation, educated guessing, and the like. So just bear that in mind. So where are we now in terms of COVID-19 in South Africa and probably Namibia as well? In terms of number of people infected, we are reaching what we would call, everybody almost being infected. This is results of this is the prevalence or estimates of the prevalence of antibodies amongst blood donors in South Africa. This was done in March 2022, and what you can see here is different types of antibodies here. Now, the anti-spike is the sort of the antibodies that are produced by infection or vaccinations. And we see that 97% of blood donors already have these antibodies. And that would indicate that 97% of blood donors are probably either vaccinated or infected or both. I'm not going to try and say that this antibody, this antibody only really occurs if you've actually been infected already. And what we see in South Africa is 87% of people had already been infected in March, or blood donors, I have to say, had been infected by March. So that's indicating high levels of prevalence of antibodies, such that only just over 2% of people had no antibodies for COVID-19 in March when the study was done. So that's indicating that we should have a real we already have a significant infection rate around that, and we would hope, given the amount of excess deaths we've seen, that these figures were high, because obviously those infections has really cost us a lot of people dying during the pandemic. So thinking about that, we think we should be reasonably well protected, because vaccination and infection both provide good predictions to severe outcomes of infection going forward. But there's a couple of scenarios we need to think about in terms of that. Now, our CMO does this presentation. I'm going to try and summarize it in one slide, so forgive me, because I'm not as medically expert as he is. But the first thing we need to realize is that the future scenario of herd immunity is not something that is real. I'll cover it in the next slide, but what you can see, we already reached essentially almost 100% infection, and COVID-19 continues. So herd immunity is not something we can attain because of various reasons, which I'll cover in the next slide. We are more likely to face an endemic COVID-19 going forward, and that's the scenario that we hope for, and it's the best. It's probably a reasonable guess as to what's going to happen. However, we still have significant risk of severe COVID-19 going forward. We could experience the virus can mutate, and there's various scenarios in which it mutates. If it starts mutating, we could find altered disease symptoms and perhaps more severe outcomes again from COVID-19 as the virus mutates. Another threat is a recombinant virus that kind of recombines and almost becomes a novel virus again. And the zoonotic risk is really highlighted in this case, because what's happening at present is humans are actually infecting animals quite a bit. So there's talk of deer. There's deer in Northern America that still has the alpha variant. The variant has kind of disappeared for all intents and purposes around the world. There's deer running around still getting the alpha variant, and they are infecting people back as well. And we have similar scenarios with mink. We have hamsters being infected by people and then reinfecting people again. The risk there is that at some point in that process, a recombination virus can happen where the virus kind of mutates relatively quickly with itself and becomes quite different and quite more severe. So that's a risk that we continue to face in terms of COVID-19. And there's also risk that the virus becomes adept at exploiting antibodies. Now, dengue virus, if you didn't know that, is a virus that exploits its antibodies. The first time you get dengue fever, you have potentially a milder disease. The next time you get a dengue fever, you actually have a more severe disease. And even some of the vaccinations has the same effect. So if you're actually vaccinated, you will get worse disease if you weren't vaccinated for dengue fever. And that kind of response is something that we need to be worried about, because we all have antibodies now, pretty much, and that's sort of a risk that could happen if the disease mutates further. So I want to say we think we're in an endemic. We're looking forward to, our best hope is that we stay in endemic, but there's still a big risk to go somewhere else in terms of COVID-19. In terms of the sort of endemic scenario, what does that mean? It means we're actually going to get COVID again and again. We're going to continue to get reinfected because our immunity to infection actually wanes. Both vaccination and prior infection is not protective. I'm on my third. I had my third COVID-19 recently, so I'm experiencing this again and again. To be honest here, so that it does actually happen and it can happen. However, what we're experiencing is essentially a sort of reduced severity of the infection every time, and with vaccination and infection, outcomes are becoming milder and less severe, and the risk of severe outcomes is reduced. So that is sort of great news in a way, but there is still some uncertainty because, as we said, the virus can mutate and change, and the immunity could wane over time. However, against severe outcomes, it does appear that the things are looking positive in terms of longer-term protection against death and hospitalization, in particular for reinfection. So we're looking positive for that. But what this means is we might expect continuing waves of COVID-19 in the future, and then we expect it to somehow stabilize into a sort of a standing, maybe wave-like pattern like you see at the bottom here. And these things all depend on the rate at which the immunity wanes, how quickly does our immunity wanes, what the severity is of that sort of risk, and then also what the transmissibility of the disease does. And obviously the transmissibility keeps apparently increasing with successive variants. What controls we put in place, if any, what vaccination and boosting patterns are like, and what this underlying seasonality of the virus is. Also, how quickly the virus mutates. So if the virus is mutating quickly, we might see quicker spikes, quicker waves between them. And the level at which, whether it ends up in a high or a low sort of level of ongoing disease would depend on how quickly the immunity wanes. So what we have, unfortunately, with all of these sort of parameters is uncertainty. We don't know what the true results are for each of these parameters, and we actually these are changing as well fairly rapidly. So it's very difficult to set a level here. So in terms of this sort of toy model that just tries to illustrate this concept, we don't know whether we're going to end up there or there, and that's one of the difficulties there. So in terms of endemic COVID, we don't know what level of impact of cases and what impact on mortality it's going to be in the longer term. Well, we can make some educated guesses. But in the medium term or the near term, there's a lot of things that are going to be impacting COVID-19 or going to be impacting mortality as a result of this pandemic. Not only the COVID-19 diuretic, which is going to continue to result in higher mortality, but things like delayed medical treatment, long COVID, we think those are going to continue to reduce or worsen our mortality in the future years. There's also, people are talking about some of the positives. Some people are thinking accelerated deaths among our unhealthy might reduce mortality going forward. This concept is really around people that COVID-19 had affected people with severe mortality in the last couple of years, resulting in a better than expected mortality in the next couple of years. We've run the numbers and we've looked at that, and we don't think it's going to affect people of life insurance ages or group risk insurance ages that much. We think it's really for the elderly or the severely impaired. We might see some positive mortality experience going forward, but not in the normal ages of life insurance and risk insurance for employers. No, we don't really see that effect coming through. We think in the longer term, we might see some technological innovation due to the vaccines and similar sort of improvements, and we think that might actually affect our mortality in the longer term. For example, think about HIV and cancer treatments being improved by the medical research recently. So I'm going to dive into some of these concepts first. Our global R&D team did some research trying to say, what would COVID-19 look like if it behaved similar to the flu? Now, what you see here is a Sweden mortality, which shows their mortality varying over time during different seasons, especially particularly inside of a year. Because they had such a long record, their mortality varies, in a seasonal pattern every year. And how can we then use that sort of variability to try and estimate maybe what COVID-19 would look like if it was added to this list and in terms of an endemic state? So this is what they've done. They did some maths, they did some models, and they estimated, based on a little bit of a guess, to be honest, because it's really around, if the variability of COVID-19 increases the variability of annual mortality, we expect between 0 and 4% additional mortality in the high income countries for COVID-19 in every year, because now it becomes an endemic disease and it's another disease in terms of something that we need to look at. So that is kind of what they expect there. It's expected to be higher, unfortunately, in the lower income countries, such as South Africa, or low middle income countries such as South Africa and Namibia. So that's kind of one scenario in terms of trying to look at it. So the ongoing COVID-19 might be 0 to 4%. In terms of excess mortality, South Africa is currently sitting at 10%. So we expect that to come down to levels such as this going forward over the next couple of years. So that's just COVID-19. The same team also actually tried to research the impact of delayed treatment. For example, the delayed treatment on mortality the impact of mortality of delayed cancer detection. So if your cancer is detected later rather than earlier, your mortality actually increases due to cancer, because the later you detect it, the fewer treatment options there are. And what they did is they used UK data where they were able to look at the reduction in cancer incidence during the early April, May, June of 2020 in the UK, and they estimated what the impact of these group of cancers that were essentially missed and are only going to be detected later, what the impact of that on the UK mortality might be. Here you get the relative risk of mortality increasing as the detection delay increases, and you can see, no delay is a relative risk of 1, i.e. no impact. Some delay increases the mortality by 6 and 14%. And their conclusion was, depending on which scenario of sort of catch up there occurs, that the additional mortality might be somewhere between 1.5% and 7% in the UK in terms of additional mortality due to late detection of a bunch of cancers during the COVID-19 pandemic. And this would also, similar effects would apply to HIV/AIDS treatment and TB treatment that we see in South Africa as well. So in terms of delayed treatment resulting in higher mortality. The other bit that I'm not talking that much about in this presentation, but I just want to pause on it for one bit, is COVID-19 and disability. We think there remains significant uncertainty in terms of the impact of COVID-19 on disability. We've seen in the retail side, in the individual insurance side, we see significant uptick in claims for people with short waiting period or short deferred period products, where people were booked off work because they, especially medical professionals, were booked off work and they couldn't work due to exposure and or infection of COVID-19. Didn't really necessarily result in severe outcome for them, but they couldn't work, and that resulted in a spike in disability claims. That remains a concern, and we've done product changes with our clients. We suggested product changes to our clients to reduce the risk of that happening and affecting the viability of the product. But we think the worsening economic situation we have now, along with concerns about mental health, as well as concerns around long COVID and changing societal norms around these topics, might result in an increase in disability claims going forward, and that might impact the longer waiting periods, such that 1 month, 3 months, 6 months, as we see in group risk, that might be impacting disability experience going forward. So we're a little bit concerned about that, and we think it's definitely something to keep an eye on. So in terms of the medium term or the near term, sort of the present, if you will, we think on balance things are not looking great. We're still going to see higher mortality in the near term due to all of these impacts. On the positives do not really outweigh the negatives at the moment, and particularly the COVID-19 direct hit, impact of delayed treatment and long COVID might continue to weigh on mortality experience for the next couple of years. Hopefully reducing with time, as one would hope, with the severe risk that the COVID direct, or with the risk still that the COVID-19 direct could worsen if the virus mutates rapidly, or some sort of genetic type of change happens on the virus, which is still not a non-zero probability. And then we can talk about the future, and I want to just highlight some thoughts on future pandemics that we've learned from this pandemic. Pandemics don't come around often, usually, and therefore we using this as a lesson to understand how we need to handle pandemics. As a reinsurer that expects to survive these massive events, because we want to be able to support our clients, we support yourselves. We need to really think about what the implications are. And unfortunately, the implications is, in terms of the incidence, the rate of occurrence, if you will, of pandemics is not looking good. In terms of that, we really think that the incidence of pandemics has increased in the recent past. If you look at the near misses over the last 20 years, you have SARS-1, we have MERS, we have a few influenzas, and that is near misses we've had in the last 20 years or so. There's also an increased opportunity for zoonotic events to occur, where we're seeing humans and food and animals come together in strange ways, in strange places. That is where these zoonotic events happen. The paper on the right, or the graph, or the map on the right, is a map of these hotspots where land use change and livestock changes has resulted in these hotspots, the probability of these events occurring, increasing, and this is happening in Asia, but you can also see in other parts of the world there as well on that map that they produced there, which really indicates that we're potentially seeing higher risk of events in future. And also the coronavirus pandemics, the SARS-1 as well, led to an increase in the number of laboratories studying these kind of viruses. And we think that the increased number of labs studying these things has an impact on the increased risk of accidents happening and potentially resulting in some of these viruses coming out. We also have the risk of malicious behavior that has in the past not really been that big a factor, but since 9/11, terrorism and that kind of thing has really raised its head in a significant way, and we think there's a risk of people being malicious with these viruses and trying to release them to damage the world. So the incidence rate, one might have thought 1 in 100, but we're thinking it's somewhere between 1 in 25 and 1 in 50 in terms of the potential incidence rate of future pandemics, a lot higher than we would have thought otherwise. So for the world, that has massive implications, because we think in terms of risk managing for life insurance in the longer term, you need to really allow for pandemics almost in your pricing, because you need to be able to pay out in pandemics and be able to support to fund that cost in the long term. Then in terms of the severity of these pandemics, it's also been a very interesting lesson. We think what you see here is plotted the excess deaths in a number of countries. Many countries that have excess deaths and track that statistics are plotted here, and you see in grey you see the typical mortality outside of pandemic years. In the red you see the 2020, in blue the 2021, and in the orange the 2022 mortality for these countries. You can see South Africa down here. Namibia is unfortunately not on this chart. Baseline there you can see significant peaks for South Africa as excess mortality was very high. To contrast that with Australia, you can see Australia's patterns were very close to normal during the first 2 years, with a bit of a peak in 2022 there. So what I'm trying to show you is the absolute variation of outcomes of excess mortality around the world in terms of the impact of COVID-19 on mortality around different countries. Now, researchers have already thought about the fact that some countries are more prepared or prepared for pandemics and epidemics. This is a paper from 2019 where they really think about what kind of structures, what kind of features of countries drive better responses to epidemics and pandemics. And the things that they look at is things like public health infrastructure, physical infrastructure, institutional capacity such as political stability, vital registration, which I guess is important in terms of tracking excess deaths, economic resources, per capita income, health spending, beds per person, doctors per person, etc., and public health communications. Using this data in 2019, they produced this sort of risk map in terms of countries that are more at risk and less at risk or less prepared for pandemics and epidemics. And you can see South Africa did pretty well here. We were second best. Namibia was in the third category. And what you can see, they probably got it a little bit wrong because South Africa had one of the worst results of the pandemic, around the world. So South Africa was clearly not in the right box. And perhaps even the US was not in the right box because they certainly didn't do the best. Well, they certainly weren't in the best category. Canada and Europe were perhaps the best, and obviously Australia and New Zealand as well in terms of the response. So they missed a lot of factors that could potentially explain. Just checking my time here. Sorry, I just want to make sure I'm not over time. These things explained some of the risk here. So, and vaccine distribution is one of the things that probably missed during that, and I think that was a big driver here. Now, January I worked on January's modelling in terms of this, trying to understand the impact of the things that drove more severe and less severe pandemics around the world. This is our modelling that we've done there. Here you can see what the actual excess deaths was, the higher numbers being worse excess deaths. On the bottom, you can see the predicted excess deaths from a model that we built. The drivers in these models are things like GDP per capita, inequality Gini coefficients, as well as hospital capacity, health expenditure, and hospital capacity, and doctors per person in the country drove this variation here. We're trying to look at things that are not immediate patterns directly linked to COVID, but sort of long-term features that might explain variations there. And the conclusion is that lower income and lower middle income countries will continue to observe worse pandemics. Given if a pandemic occurred, it's likely that countries like South Africa and Namibia will see far worse outcomes than countries like the higher income countries of the world. You can see here in brown, Europe is up down here a lot. So countries like South Africa and Namibia will continue to given a pandemic, we will see more severe outcomes, which means really that has changed. That is a change. Reinsurers had been allowing for pandemics in their pricing and their risk management, but they had kind of treated everybody as equal around the world. They kind of treated countries as equal, and now reinsurers realize that needs to change. We need to treat different countries differently to be able to maintain our business in various countries. So what you'll see is that in countries like South Africa and Namibia, the cost of pandemics might be as high as 5% or higher for going on a going forward basis due to the increased incidence as well as the increased severity in lower income countries such as South Africa and Namibia. So that is something that's really going to change the way we think about it. So after that sort of whirlwind tour of the past, the present, and future, I just wanted to summarize and just sort of gather my thoughts on this slide. And really, I think, as Patricia said, COVID has had a massive impact on society, on Namibia and South Africa, and in particular in terms of the severe mortality outcomes and morbidity outcomes. And those impacts will continue, and they will also continue to affect the life insurance industry in these countries in significant ways, with higher midterm mortality than we'd expect otherwise, and morbidity and disability remaining at risk of deteriorating fairly rapidly if the world economic situation continues as is. Future pandemics also has changed. Our views on future pandemics has also changed because we realize that the incidence of pandemics might be higher than we expected, as well as the severity in low middle income countries could be much higher than we assumed before. And that means reinsurers are already shifting their views on risk. And after 9/11, reinsurers reassessed a lot of property and casualty risk, a lot of non-life risks, because that was a significant loss event for that industry. And this pandemic is in a similar realm, changing the way we think about life and health, tail risks in particular, and the uncertainty around them, and as well as the systemic risks around that. I mean, it's absolutely, some of these things really are on and off switches in terms of affecting the outcomes of COVID-19, and it's very difficult to predict. So COVID-19 will continue to have an impact on the life insurance market and in terms of the group risk market in South Africa and Namibia. So I thank you for the time. I think I've gone slightly over time, but happy to take some questions. Thank you very much.
Thank you, Louis. It was really, really interesting. I got quite a few gems out of that presentation. I hope that you did too. We'd like to open the floor for questions, not only to those who are here, but also our online guests. So we have a roving mic, as far as I know. And if you do have a question, please raise your hand and we'll get that mic to you as soon as possible. No questions as yet. We're all stunned. Okay, well, perhaps I'll ask a question so long. Hopefully that will get the questions rolling. Louis, so it looks quite bleak for us here in Namibia. We're expecting COVID to be endemic, possibly. That will result, if I recall correctly, between 0 and 4% excess deaths. There are also then the other impacts of mental health issues, long COVID, which could also impact pricing. That's as yet uncertain. And then we in Namibia, I think as you indicated towards the end of your presentation, reinsurers are realizing that we've been paying less than we should. So that will also impact costs. Do you have sort of an estimate? I know it's difficult, but an estimate as to roughly to what extent are reinsurance or life reinsurance and possibly insurance costs are likely to increase over the next year or two?
Sure, that is a very good question and a very difficult one to answer because there's lots of different circumstances, particularly in the group risk space where you have different industries, you have different salaries, you have different mix of business. But I think you would expect at least 10 to 20% above normal costs to continue to remain the norm because of the increased risk of pandemics that are being assessed now, plus the increased mortality that remains a case. So in South Africa, excess mortality remains at 10% above normal, even though our cases are the lowest since almost the start of the pandemic at the moment. So that tells you that the underlying drivers are still, the driver's mortality is still negative in negative territory, and that will continue to affect us going forward. So, and the other side of that is different reinsurers. I think January was I wanted to do a little bit of a humble brag. We were pretty on top of it and understood the implications earlier, so we perhaps increased our pricing a lot sooner than our competitors did. But our competitors some of them are catching up now. So there's a lack of capacity often in the group risk market where reinsurers are potentially pricing themselves almost out of the market to avoid potential uncertainty going forward. So you have that risk as well. So not only is it a theoretical sort of what is the best estimate view there, but it's also people worried about the uncertainty and therefore pricing way above what might be a best estimate. Although it's very difficult to assess best estimates in this scenario, it's very difficult to know what's going to happen.
Okay, thanks, Louis. We have two questions. We'll just get our mics. Well, I'll mic to you. Okay.
Thank you, Carmen. Louis, I think in this sense we've actually reached a vicious circle because the developing countries will have to pay more for insurance because of what is the current situation that you explained, and the developed countries will probably pay less for reinsurance. But my challenge is just so it means that fewer and fewer people will be able to afford insurance and risk. Do you have any mitigating factor for us in the developing world?
Sure. I think I get very grumpy when I think about this myself because I'm part of a global reinsurance company, but I'm also South African, and I felt that there were some ongoing problems around, say, the distribution of vaccines, which I think was not done particularly well, and certainly favoured the developing world. And I think we could have saved a lot of lives in South Africa and Namibia if we had received vaccines in a more let's say fair way. So that to me is and then to be almost then to have to say, well, actually our risk is higher in South Africa, then we need to charge more compared to these countries. It feels a little bit unjust, but unfortunately I think the reality is that the mortality is higher in countries like South Africa and Namibia, and therefore there is a higher risk even if vaccines were distributed more fairly. So that is the unfortunate reality, and it's always been the case. Our outcomes with HIV was also worse in our countries compared to the developed world, and similar with other diseases as well. So I think we have a higher risk. I think we have amazing innovation in the life insurance space in sub-Saharan Africa and South Africa and Namibia. We have that, and we have technology that hopefully changes. And I also think that we hope to see some more research in diseases like COVID-19 in South Africa, and cheaper and better ways to actually address those risks going forward. I think the genetics work from some of the labs in South Africa has been absolutely world class. I think our medical industry is world class, and I think some of our numbers people are pretty good too. So I think we've done well in that area, and if we can expand on that and get a better response going forward, certainly I would push for better better rates for South Africa. If we were able to produce more vaccines locally and things like that, I think that would be the positive side.
I think this is more a question for corporate. Would the 10 to 20% then be an indication of the increase in your underlying rates?
I don't want to say that that's definitely going to be the case, because each group has got its own risk factors, if I can put it that way. So we'll look at each group in their own right, if I can call it that. But yes, I think the industry does need to be aware that there will be an increase in rates, and not just from Old Mutual, I think from other insurers as well. Yeah.
Perhaps I can just say I was not speaking for Old Mutual in that case. I was speaking for January there. So just to highlight that Old Mutual might have different views to mine. In particular, Old Mutual would know the local circumstances and the circumstances of each group. So I was speaking for a general, very high-level view of risk in South Africa and Namibia.
Okay, I think. Can we take one more question?
Thank you, Carmen. Thank you, Louis, as well. It's a question for Louis. On your slide on the sum assured burns, I'm just not sure if I fully agree in the context of Namibia, and maybe it's because of the underreporting we have. I feel as though the gap should be bigger for the higher income bands, but I saw on your graph it's the opposite. Do you maybe have a bit of color on that, just on your own personal experience?
Yeah, I mean, it's a very difficult graph to explain that, and I probably didn't do it justice. The main result is that in lower income, people with lower incomes and lower sum assured had higher additional mortality due to COVID. Okay, so there's a big gap there. That gap in terms of claims is not due to underreporting of COVID-19. We looked at excess claims that we paid out, literally just the number of claims we paid out. We didn't try to assess whether they are due to COVID directly, because as in many parts of the world, COVID is underreported as a cause of death. It's underreported as in the daily numbers that we see around the world. And particularly in developing countries like South Africa and Namibia. So that number is not subject to really underreporting. What we see is that in terms of additional mortality, the lower income people did worse, unfortunately. But in terms of relative to what we'd expect for each category, the higher incomes did worse, because even that small increase in the high income turned out to be a large proportion of the underlying mortality, pre-COVID mortality, if you will. And that additional percentage is why the high incomes look worse in relative terms or in percentage terms. Does that help?
Yes, thanks, Louis. One more question, and then unfortunately we have to wrap up.
I'm not from the industry, so please forgive me. It's from a layman's viewpoint. Louis, we saw the non-alignment of thought between politicians and scientists, at times even arm wrestling. From reinsurance point of view, it appears to me that you guys are the prophets of doom. You are suggesting that the developing countries, and most of them are on the continent of Africa, haven't actually learned that it's just going to be same old. Infrastructure, we saw the shortcomings there, vaccine distribution, responsiveness, copy and paste at times by just following what other countries are doing in terms of mobility of people and closing borders and so on. And we still see that. Namibia requires vaccination certificates, PCR or PCR tests. South Africa doesn't. So, these are countries, right? And now borders are porous and so on. So I wonder if the reinsurance industry around the world is just saying, okay, guys, we're going to punish you with rates. I would even want to suggest that perhaps this presentation you made today, you should be making to politicians actually, as a wake-up call for them to get their act together. So I don't know, you may or may not respond to that, but it seems to me is that if the belief generally is that same old, you guys didn't learn, so we're going to suffer, we're going to punish you, you're going to suffer, and of course it trickles down to the population.
Yeah.
I'm from the industry. I'm not from the industry. I'm just an entrepreneur.
No,
who've walked my journey, and I now work with entrepreneurs, helping them do things better.
Yeah, I think I wouldn't want to be a politician. And I don't know about the details of what happened in Namibia in terms of how people reacted, but I wouldn't want to have been a politician during this time, because I think it was the most difficult set of circumstances for any politician around the world, pretty much, because you had to manage tremendous uncertainty, right? And that was the big thing that people don't realize, and that's kind of what I also highlight to, is it wasn't a known risk, it was a high uncertain risk, especially in March 2020. People didn't know how bad it could get, right? So you were dealing with the absolute potential for very bad outcomes. And unfortunately, it was very bad, but it actually could have been a lot worse, right? And that's what people don't realize. And unfortunately, in retrospect, or even in the time, people managed to what is in front of them. They didn't think about managing towards the uncertainty. And I think, I think South Africa, we did okay. I think the government did okay in terms of actually addressing the potential downsides of the risk, right? Trying to address the potential downsides there and reduce the risk. And I think, I mean, I've done some modeling, and I want to read around those models and see what would happen if the South Africa did nothing, right? If the government didn't do any lockdowns, and the results would be far worse, I suspect. The problem is, of course, that our ability to respond is not as good as other countries, because we have people living in townships, people can't, we don't have the financial infrastructure, we have a lot of less ability to respond. So, and that is not something that's easy to take away. So I think being heavily critical of government is not a bad thing, but I think in some cases, I think we did fairly well. We responded quite early, and I think it saved lives. Could we have done better? Certainly. Could we not have had some ridiculous laws? Probably, but certainly from my point of view, the response wasn't too bad, especially early on. Unfortunately, there's corruption. There's all sorts of other issues that I don't really want to address now, but I do think I think it's very difficult to manage the uncertainty, and that's our job as reinsurers. We are there to look at, what's the current risk and what's the potential for risk to get worse, and we see that potentially is worse. I have spoken to government. I have presented to the Western Cape government. I have to an ad hoc committee for COVID-19, and I have various sort of engagements informally with some sort of public health people in this context. But yeah, it is a difficult thing to manage. We think that a lot of that additional risk that's faced by the developing world is really around the ability to respond, not necessarily the willingness to respond as well. So I just want to draw that distinction, but obviously there's problems on the side.
Thank you, Louis, and thank you for the questions. Just while Louis was presenting, I was thinking of a GPS. I think actuaries are a bit like that. We plot a route for you, and then things go off track and there's recalculating. But at least we have some cool endemic projection toys to work with. I recall you referring to a toy, Louis, so it's not all doom and gloom. I think it's quite an interesting profession, making sense out of uncertainty. So thank you, Louis. We really appreciate your presentation this morning, and I'll hand back to Hilda.
Thanks. I'm sorry I couldn't be there. Thank you very much.
Thank you very much. Louis, are you still with us, or are you going to remain with us?
I unfortunately need to go, sorry.
All right. I have a friend. So the mistake I made is when I got the link from the guys at the back, I sent it to all my friends. So now these are not pension fund professionals, or like I think we just heard, entrepreneurs, and I'm being harassed by one of them particularly to ask this question before you get to go. It relates to the question on the low income groups. Maybe perhaps if you could define because I think the frightening statement was that low income group people, more of them died. Specifically, let me read the question. Did people in the low income group really have greater mortality rates? And could you ask Louis to define what lower income gaps, what they look like, and it will probably help this person to make better sense of your question.
Okay.
If you could just quickly deal with that.
Okay. Maybe I'll just address it like this. We don't have a strict definition because we can only see what the sums assured are policies in that we are covering. So we see that lower sums assured, people with 100,000 rand sum assured would be different to somebody with a 3 million rand sum assured, right? Or 100 NAM dollar versus 3 million NAM dollar would have different sum assured. And therefore, the different sum assured probably reflects a different underlying income level, because somebody who takes a cover for 3 million probably doesn't necessarily take cover for 100,000 and vice versa. So based on that, we're making conclusions that we're making inferences or guesses that lower income had higher additional mortality, right? So for every, let's say, I'm just making theoretical numbers here. Let's say in the high income group, maybe 1 in 1,000 died from COVID-19, and in the lower income group, maybe 2 in 1,000 died from COVID-19, right? Unfortunately, when you looked at it as percentage terms, in general, that low-income group, as we defined by Sum Assured, has already higher mortality because of other things, which are very difficult to know exactly what they are, but different lifestyle, different economic circumstances. So the underlying mortality might already be higher for that group. And in percentage terms, that two per thousand extra that COVID experienced was a lot less in percentage terms for the low-income group than for the high-income group. And unfortunately, that effect of higher percentage impact on the highest sums assured has a financial implication for life insurers, because those high percentages and the higher amounts of cover translate into a bigger financial impact for life insurance. So that's the situation there. But certainly our expectation would be, all else being equal, similar age, similar gender profile, low income groups would have had higher absolute levels of mortality due to COVID-19, but they also have higher underlying levels of mortality as well.
Thank you. Appreciate your time. And thank you very much for
No
spending
worries.
your morning with us.
Thanks for allowing me to present.
So for those of you in the room, I'm sure you would love to have a bit of refreshment. So we'd like to offer a quick 5 to 10 minute coffee break, and then we'll invite you back for the start of the panel discussion. In the meanwhile, as you move out, please invite your friends to watch us on Facebook and as well as on the YouTube Old Mutual channel for this conversation this morning. Thank you. But that's how I guess people know that their mics are switched on. But fortunately, we don't quite have to do it this morning. So thank you for being back. I hope you are warm and a little bit refreshed. And now we're going to get into the panel discussion. So I'm going to call on the panel, and they're going to find themselves seats to either my left or right. So let me start with the only lady on the panel this morning. And as you know her, she is Gail van Wyk. Now, Gail is proof that good things also happen on the 1st of April. Because it was on that day that Gail, and no, I'm not giving away her date of birth, took office as the Corporate Governance Executive and Chief Risk Officer at Old Mutual Namibia. Having cut her teeth in a wide range of professions, such as lecturing in fields such as commercial law, Gail spent time with Alexander Forbes Financial Services and also worked as a lawyer, focusing on estates and financial services. So, ladies and gentlemen, would you warmly welcome, as she comes to the stage, Ms. Gail van Wyk. Then I'm going to call on Martinez Fabianus, who I think is almost synonymous with the industry in which he serves. He's the Managing Director of the Retirement Fund Solutions, studied at the University of Science and Technology, then the Polytech, now called NUST, and he studied in the fields of commerce and business management, followed up that qualification with qualification from the University of Stellenbosch, Executive Development Program, and further studies also at the ILO's International Training Center in Turin, Italy. I envy you for that. So, ladies and gentlemen, would you please warmly welcome Martinez Fabianus. I sometimes, well, I walk for exercise, and I've had to run across him a few times during my Saturday morning route on the road. Martinez always runs fast, and the one morning I remember he overtook me and his wife was behind, and I was like, "You being left behind?" And she was like, "He just likes to show off." Johan started at PwC in 2006. An illustrious career professional, Johan spent a year in Jersey, in the Channel Islands, working on trust and fund industries. He's responsible for all tax matters at PwC, and he frequently collaborates with taxation experts in the global network for PwC. Good morning, Johan, and welcome. Last but not least is Sibyl Scholz, who is an LLB graduate, and he's fixated with matters, legal matters of an industrial nature. A principal officer of one of the country's largest preservation funds when he worked for Old Mutual, Mr. Scholz is currently responsible for operations at RFN. Currently in his final year of his MBA, Sidwell also helps to provide strategic direction in the industry, which he believes are the moves that the industry needs to make to move forward. Ladies and gentlemen, welcome Mr. Scholz. They look rather nice, don't you think? So let me start by asking the very first question, and we're going to try and do this in as ordinary linguistically as possible. Ramon knows language makes me crazy, and when people use big highfalutin English words, which is not our first language in the country, it makes me nuts because people don't understand nothing about retirement solutions, and then people still use big words. So please don't use big words this morning. We know you guys are smart. Okay? Let's just settle that. So, Gail, let me start by asking you the very first question. The reason why we're here this morning and the discussion for this morning is really to focus on this NAMFISA directive. We all know what it was. I don't have to read the specific number. But it was a big one because it affected the retirement industry sector as regards, and specifically in the manner in which it handles approved benefits. Let's start there. What was this directive about, and how did it impact the industry?
Can I be controversial?
You are allowed to be as controversial as you want to be.
All right, so I'm going to start
You just move up your microphone, yeah.
by saying the directive that we're referring to was the February directive that Namfisa issued around us having to define benefits clearly to fund members. I don't think it affected approved benefits. At no point in time did the directive say retirement funds may no longer have approved benefits on their funds. I think that's the first thing I'd like to say. The second thing I'd like to say is that I think the directive is fair in how they are trying to position the members' interest in the industry. Members are paying risk benefits in their funds as part of their contributions. But I think if I ask around the room, and I see a lot of my ex-trustees, colleagues, etc., that I've worked with in the industry, how many of your funds actually define what the risk benefit is in the rules that the member is actually contributing for? So does it actually say what are the conditions that that member needs to comply with in order for a disability benefit to become a legitimate claim against the fund? In my interpretation of this circular, Namfisa is asking industry to be clearer in how they communicate. I mean, we communicate what a withdrawal benefit is. When are you entitled to it? To what extent are you entitled to it? So if you define benefit or define contribution fund, it actually stipulates in your fund rules what it is. But we don't do that for risk benefits. We don't say to members in risk benefits, you're entitled to disability benefit, but the disability benefit is subject to these particular conditions. So I think Namfisa is trying to get clarity because members need to get certainty about what they are paying for, what those benefits are, in plain, simple language. And there's various means that the funds can actually respond to that. So that's my start on the controversial. I don't think it removes anything from members or funds. It's asking for clarity. And very often, I think Louis made the point that risk benefits are becoming so much more expensive. Individuals really can't afford any longer to have their own risk benefits. They are looking for group opportunities to actually get a cheaper rate and a cheaper opportunity to get in there. Yeah. But we have a responsibility as trustees to make sure that members actually understand what they are in for, if I can put it that way, to start off.
That was quite a bombshell, because that is just significantly different from the departure point we had. So let me hear from you, Mr. Fabianus. Is that the same way as Gail explained it, as you understood it when it landed with you?
Well, yeah, I think let's try and delve into this. My understanding, obviously, is that Namfisa would like pension funds to be a whole lot more prescriptive on the terms, the conditions under which a member may qualify for benefits. But they go a whole lot further than that. What is a whole lot further? Now, Namfisa says you must not, as a pension fund, do anything other than provide retirement benefits. If you provide certain types of benefits, which is primarily the domain of an insurance company or business, then you are seen as basically extending your boundaries in providing insurance benefits. And if you do that, then you will have to make sure that you are not seen as though you are abdicating responsibility by, for example, saying that the terms and conditions under which you may qualify for those benefits are set out by an insurance company, and you should do that in the rules of your fund. Now, just for a moment consider the typical terms and conditions that an insurer defines. And I think we've heard earlier just what significant benefits insurance companies have paid out under a pandemic environment, which was COVID. Now, a pandemic is something that's completely new. Just think about the Marindal floods, for example, that happened a few years ago in the short-term insurance space in the south of the country. A lot of the town of Marindal was flooded, and then what happened subsequently was that most of the insurance companies said, okay, you know what, we didn't foresee the flood risk, so we are going to exclude Marindal as a town and maybe a few underlying areas from our insurance cover. Now what that did was that because they did not foresee the flood risk, they initially covered and they suffered significant losses. So in the same way, this COVID-related deaths were essentially under a pandemic situation. But the insurers did not foresee it, and therefore they were left with no choice but to cover. Now, if Old Mutual we've had paid out about $1 billion, that would have been a significant amount of money that they would have had to pay in relation probably to the premiums that they have collected. So if they knew that something like that was going to happen, the insurers probably would have made sure that they don't get themselves into a situation like that. Now, pension funds don't have that luxury. So if you are, as an insurer, required to define what a pandemic is, it's going to be extremely difficult. But by the same token, there are a number of other terms and conditions which would be very difficult to try and define in the rules for the ordinary member, because there's also a provision in the Pension Funds Act that members should be able to read from the rules what benefits they expect. And that's why it becomes extremely difficult and controversial. Let me stop there for now.
Wow, okay. So let me come to you, Mr. Scholtz-Sitwell. We've heard about the broader issues. I'd like to hear from the sector-specific, the retirement funds. Obviously, the directive comes from NAMFISA. It's now time to implement. First and foremost, I'd like to just hear if you would just quickly dwell on the levels of consultation prior to the directive arriving on your desk in February, but then also how have the sector adjusted to this directive being issued? What do you hear from members?
Okay, so I think I'm going to tie in with Gail's controversy on this. Firstly, there wasn't much consultation before the time. We had an initial engagement with the NAMFISA where we discussed the matter, and we were then tasked to approach the Namibia Savings and Investments Association, which we then did. And jointly we were working on a position paper on how we can deal with the interim arrangement and then also look at going forward in the standards when FEMA comes. So from the industry side, the position is you cannot unapprove rules because the directive currently says the rules are not valid or unapproved, not valid in the extent that it does not comply with the Act. So where the rules do not define under which circumstances members are entitled to the benefit and the benefit does not pay, NAMFISA then expects the fund to step in as guarantor and an insurer to make sure that the funds then are paid out to the member because they are under the impression they have the benefit. So as far as extensive consultations are concerned, we have not had those luxuries with NAMFISA before, only the one initial engagement.
Now, I think the key issue, and I'd like to come to you, Johan, obviously you being a tax expert, what used to happen before this directive was issued was that companies, as they extend pension benefits to a member, had a tax benefit. How does that impact them now? Would you like to talk a little bit about the tax implications, please, after the removal of these risk benefits?
So I'm glad that two of the other panelists already made controversial statements, because
so you
what
can
I'm
go
about
ahead.
to say will probably shock some of you. But I think it's important to start that the whole principle of a company contribution being paid, there's nothing in the Income Tax Act that says that that company contribution should not be subject to tax. It's the best practice that's being applied in the market. So currently, if your medical aid or your pension fund contributions are being made, that's seen as a, let's call it an exempt form of remuneration, and there's no income tax levied on that, or no pay-as-you-earn. What we have found that is, whether it's on an approved or unapproved basis, if you're making one premium towards a pension fund and you're not paying separately for the risk premium, then it's fine to say that it's a pension fund contribution and that portion is then exempt of tax, or it's not being subjected to pay-as-you-earn. But if the moment that you're starting to make a separate premium, so if there's a separate premium that you're paying as part of the risk cover, let's say in our case, if I'm making a pension fund contribution and there's another, even though I pay to my pension fund, there's another portion of the premium that relates to a risk benefit, then that is supposed to be subject to fringe benefit tax. And I don't think that's being applied consistently in industry, but that is how it should work. So yeah, with a potential change, I think what will definitely then happen if it's an unapproved benefits, if the retirement fund is no longer levying only one premium, or they levying the moment that they start levying different premiums, there's going to be pay-as-you-earn on that in any case. So it's not, I don't think it will be a massive change, what's coming in. I think the important thing is that the industry realizes that separate benefit that you're paying a premium for, it needs to be subject to pay-as-you-earn.
So the challenge in Namibia, and I can hear you saying, Gail, a lot, has been, and we understand where we've been this year when we talk about pension funds, retirement funds in general in the country. One of the big low-hanging fruits that people really liked about pension contributions was this tax benefit. And now?
I think funds will have to make a decision how they want to treat their approved benefits, risk benefits in their fund. Martinez is right, it becomes complex when you need to incorporate it into your fund rules. To what extent, to what degree, how do we make this member-friendly to be read by members and understood? And we're all moving towards making language easier for everybody to understand once they contract with you. So that's an important fact that funds would have to consider how to incorporate it. And it's either you put it in your rules or you incorporate it by reference, which is another thing that I think Nafisa is not comfortable with, because it leads you open to actually just slam bang that reference to the insurance contract that you have. So it becomes complicated how funds want to deal with it, that they must make a decision whether they're then going to move it outside of the fund, and it sort of becomes an unapproved benefit. And then Johan's correct, once it becomes an unapproved benefit, it becomes taxable. And at a point in time, in any event, the benefit does become taxable, whether it's pre or post-retirement. So it's something funds would have to consider, and what's going to work for them best. What I do like the fact is that it's not sort of approved benefits cannot be held on funds point blank out of it, etc. There are still options for employers to consider with their retirement fund consultants as to what to do and what's the best option to go about it. I think we need to partner well with the regulators to understand how we can actually bring a suitable solution both for the funds, so that when you have these exclusions, which we were talking about, that they are worded properly and the regulator's comfortable with it, and funds understand their liability. And I understand funds are also uncomfortable with the word liability, and I think that needs to be unpacked with the regulator properly. What does that actually mean? In approved funds, your fund always is the insured person, and the member who's unhappy about a decline actually shouldn't be taking it up with the insurer, should be taking it up with the fund.
Because that's where the relationship is.
Correct, that's where the relationship is. So the extent of liability needs to be unpacked with the regulator. I think we need to partner smartly with the regulator and finding a solution around it.
So tools to partner, have you partnered? Are you engaging? How do we move this forward so that we can partner smartly with the regulator? Mr. Fabianus.
Yeah, tools to partner, I think that's a very, very important point. And I think that's where, if you ask me, I think the regulator seem to see this as a problem for the industry to solve, as opposed to them also being part of the solution, which I think to me is actually disappointing, because the regulator has identified a problem that they, by their own admission, and have only identified very recently, because over the past 30 years, the same law has been in existence, and pension funds have been providing approved risk benefits without a problem. Now, all of a sudden, the regulator has found something that is a problem. So I think the regulator is the advisor to the policymaker. So the regulator should be able to recognize the socio-economic benefit that these benefits have been serving. 1 billion referenced by one insurer. What about the other insurers? If you tally it all up, then you would hear that it's a number of billions that would have been paid out. What would that have meant to the industry, to the country, to the communities that have had an unfortunate, in the case of the COVID pandemic, a situation of death, and now had to rely on the payouts that were made. If those payouts were not there, there would have been a lot of people that would have been left destitute. So you would think that the regulator would recognize that and say, you know what can we do to ensure that the people of this country can continue to enjoy this very important socially impactful benefits, and hold hands with the industry, so that if the law needs to be changed to allow for these benefits to be provided without any challenge, that be done. But I think, I am afraid, and that's maybe where I'm not so sure if I fully agree with Gail, that's where I would say that the solution is not that the pension funds are now all of a sudden required to take on the business of an underwriter and write everything into their rules, but rather that it's easier to outsource certain risks to an insurer, and that if need be, that the law allows for you to be able to outsource. After all, you are taking out insurance, just as the word suggests. We're not talking about the pension fund savings, which is the purpose of a retirement fund.
At this juncture, I must declare that it's becoming very difficult to remain an independent moderator, since I'm on the board of the Orion Trust, but I shall remain professional and independent. So let me come to you. Hopefully you can save me, Sidwell. Timing-wise, I hear the sentiments. They are very, 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 very well articulated. And I can hear very sensible interventions. While I hear that they have a difference of opinion in terms of what it is and how it should have been approached, I'd like to hear maybe the timing. Do you think the timing, COVID being a real big factor, did it help or did it detract from this directive really being welcomed by the industry?
Sure. There was no mention of COVID actually influencing any of the
But
decisions.
it landed smack bang at the time of...
It makes sense that it could be, because there was that spike in death claims specifically, disability claims. But sure, to do something for years and years and years a certain way, and now to go back and say that from the beginning we've been doing it wrong, things need to change now. At the NAMFISA meeting last week, we also heard that the exact same provision that is currently being the source of the controversy, Section 11D, is now being introduced into the standards as well under FEMA. So it's not even as if FEMA is going to solve the problem for going forward. We will still need to go through the same process when it comes to funds re-registering their rules.
Johan, can you talk broadly? I know you're responsible for tax by and large at PwC, but I'm sure that you have insights on a broad level about the impact of the specific directive on the Namibian society at large.
Yeah, so I think an important thing that one has to consider is that if we look at the approach that NAMRA or the Ministry of Finance specifically follows when it comes to policy development, because I have to focus on tax now, is that it's no use for everyone trying to approach them individually. As an industry, you need to find a collective body, and you need to approach them and understand or explain to them the potential impact of something like this. And one of the suggestions would be that they currently allow deductions for pension and retirement annuity funds up to 40,000, which we're hoping they're going to push to 150,000. But one of the arguments could be that are we allowed to include this risk benefits into that deduction as well? But as I said, to try and approach them on a case-by-case basis with your own set of facts is not going to yield very positive results. We need to stand together as an industry and really ask them and show them the benefit to Namibians. Because in the end, all the officials at the ministry also pay tax. It will benefit them as well. So.
Any perspectives from your side?
Yeah, maybe I can come in there. Yeah, I don't think this problem is going to be all that simple to solve. The reality here is that I think we've got a regulator that has made up its mind that it would like to see the industry move in a certain direction. And that direction, certainly the way how I see it, is that they would like pension funds to remove risk cover from their rules. They may be hiding behind the arguments that you can keep the risk benefits in the rules of your fund, provided you comply with their expectations. But the truth is that you will find it extremely difficult. And I think most of the pension funds have tried their level best over the past year to try and word the rules of their funds in different types of ways in order to try and get the approval of the regulator. And the regulator has just not been willing. And now there is a question that has to be asked: how is FEMA going to change? Is it going to be any different under FEMA? It doesn't look like it's going to be any different under FEMA, because just at the recently held industry meeting between AMFISA and the industry, they have actually taken a standard, an AMFISA standard, and they have added a provision which they have used, or that they have taken basically verbatim from the current Pension Funds Act, and they've added it to the standard. And that provision that they have added to the standard is the one that has been the reason why they issued that circular to start off with. So it is clear that the only way would be that employers will have to be forced to take out unapproved schemes if they want to continue to provide some sort of group risk to their members.
And the impact of that?
And the impact of that, obviously, as we would have heard earlier about the benefits that were paid out, it was under a COVID pandemic, but even in a normal course of business, the insurers pay out a lot of benefits, normal mortality to members of pension funds. And the average person has an average membership which has not allowed them to save enough. I mean, if you look at the life expectancy of Namibia, I think it's obviously relatively high, but you do have situations of people dying whilst they are still young, they have got young families and what have you, and the savings that a person has accumulated in the pension fund is normally not enough to provide for those families. So you have to rely on the insurance that is normally taken out over and above the savings that the member has. So the impact is definitely going to be there. And the only way how the employers can ensure that some sort of proper benefit, which is going to really secure the livelihood of dependents of members of pension funds, is by providing by taking out some sort of insurance. And that insurance will have to be taken out outside the pension fund. And I maybe want to just make it clear here. Think about disability.
Yeah.
Death is a lot more clear-cut, because if a person is dead, the person is dead.
Yeah.
You can't argue about it.
Yeah.
But if you are disabled, an insurer goes to great extents to actually determine and then eventually tell you how they have decided to consider you to be dependent, or to be defined, to be disabled. Now imagine trying to do that in the rules of your fund. It's not going to be possible. I think it's going to be very, very difficult. And you will be forced, unfortunately, to take out that disability benefit outside the fund, because you will not be able to define all the, to provide for all the disability definitions in the rules of your fund.
How to move this forward, Gail?
So I was thinking about, I think a lot of guys remember vesting back in the day, when NAMFISA also had a directive to industry to remove the vesting scales. And a lot of, and I agree with Fabianus, there was a sense of they've made a decision, therefore they are now moving industry in a specific direction through directive. And we all understand the legal jargon around directive versus regulations versus statute. And I think there were a number of funds that just stood their ground and said, we will not remove it. And they got it right that NAMFISA couldn't challenge them to move it. So you're heading down a loggerhead eventually. And Fabianus is correct that we sometimes get to those junctures with the regulator, and it's not a great way to go into a new era of FEMA. We need to find a solution to be able to be heard and find a solution that is amicable for both the funds and the regulator, and to achieve both outcomes around that. And I don't think we're there yet, because we are still sort of all in our own corners, and we don't have a facilitator to get this, to get everybody to the middle ground, in my opinion.
But the facilitator is in the room. He's sitting over there. So what do you say, sir?
It was what I was going to say just now. So we do have planned interventions where we get the industry together, form a joint view that we then take forward and take it to the regulator. So the plays are on the cards.
So what happens now? So I feel almost like the industry is in limbo. There's a directive, do this. The industry is reluctant to do this. We're not exactly sure where to go. What do we do now? What's happening currently in the current environment? Fabianus, you sound like you want to answer.
Yeah, I agree with Sedwell. Obviously, advocacy would be important, albeit seeming as though it's late at the moment, because NAMFISA, had it not been maybe because of the pressures that were put on them as a result of the one regulation that deals with compulsory preservation, which is what has made most of the activists, the public, as well as the lawmakers, a bit more awake to the various other implications of FEMA. Otherwise, we would have seen FEMA being implemented 1 October. So thankfully, it has now been postponed. So we must use the opportunity to lobby. Maybe it's not the politically correct term here, but we will have to make sure that we engage as industry and see what we can do to try and get NAMFISA, if need be, then with the help of whoever else who is a stakeholder and who has an interest, and there are various stakeholders, to realize that we're not doing ourselves any favor, and hopefully sense will prevail so that we can bring about an amendment that can allow not necessarily the prevalence of anything that was not in the best interest of members, but at least ensuring that we can maintain a very, very important socially uplifting benefits in pension funds, and that would be the only way, because the alternative of saying if NAMFISA's will prevails and employers are forced to take out unapproved schemes, I think we can be afraid that there would be quite a few employer groups that would feel, but is it still economically viable for me to even have a pension fund?
Yeah.
Because there are certain economics of scale that are inherent in a pension fund arrangement. The employer pays one contribution, and that contribution provides for all the benefits. And now you are forced to take out a very important benefit, but what are you gaining by doing that? I mean, are your service providers going to reduce their cost because you have taken this out? They would say, no, but I'm still paying out a death benefit if somebody, even if it's just a fund credit. So the costs are the same for me. But when you had an insurance element in the fund, the cost was exactly the same. So you're definitely losing on some economics of scale here. And at the end of the day, the biggest loser would be the member, and by and large the society, the Namibian society.
Yeah, because all of these discussions, they are very valuable, and we've highlighted what it would mean for the sector. But at the end of the day, it's really what it means for the member. How does it make their lives better? How does it make their lives worse? Maybe the two of you can say, if you really look at this objectively, where does that take that member? I don't know, Johan, if you would like to go into that by answering that, and then I'll hand over to Sidwell, and then, ladies and gentlemen, we'll come to those of you in the room if you have any pertinent questions.
Yeah, so maybe just on the tax side, what I can touch on is that, I mean, it has to be clear in which case the tax is really applicable. I know there's different views in industry of how these things apply, but we must make sure that we comply with the Act. So yes, any annuities being paid is definitely taxable. We're not going to get around that unless there's a specific provision that takes out disability benefits. But a lot of the insurers have got rulings from the Ministry of Finance that indicates that any disability income benefit that's being paid as an annuity would be subject to tax. And for that reason, when you pay your premiums to Old Mutual or to PPS, it also is allowed as a deduction, post-tax. So if you make your disability benefit, then it's allowed as a deduction. I think that we need to have more clarity on the lump sum payments to make sure that it is in fact taxed when it should be, and in all cases it should not be taxable. I know there's certain views that because you get it pre-tax, it has to get taxed at some point. But the Act says that any lump sums that's being paid from a retirement fund is not subject to gross income. So the gross income definition is all about, are you receiving an amount in cash or otherwise during the year of assessment, and it's capital, unless it's capital in nature. And capital in nature versus revenue in nature, if you are getting a benefit and you didn't do anything to get that benefit, it's going to be capital in nature. And anything that's capital in nature is going to be excluded. So one has to look at the definition and get back to the Act and not make assumptions around, because I've never paid tax on it and because I got a tax benefit, now that amount must be subject to tax, because it's not necessarily the case. And that way, sorry, you give the beneficiaries, you give them more disposable income.
I think we just need to be cognizant of the fact that many Namibians have these benefits as the sole provision of risk cover. So if we provide a situation where funds would then take that away from those members and something were to happen to those members, there's two things that we need to take into account. Firstly, these members have been paying for these benefits for years. Secondly, their beneficiaries would be left destitute if it's a breadwinner that falls away. So we need to actually sit back and take a step back and look at how can we benefit the member that we are all in this fight together to try and protect, and so that we advocate for the best of that specific member. To me, it's a technicality of including it in the rules, not including it in the rules. At the end of the day, we are all doing this for the member, and that is the voice that we all need to protect.
I think on that note, I'll open the floor. I think very well put. Sidwell, so any contributions, any comments from the floor? I'd like to check from the gentleman at the back. That's why I have my phone in my hand. Let me just see if there are any questions from the members of the public. In the meantime, Patty has a hand up. If you could just move to Ms. Olivier, and I see a gentleman at the back. Quite a few hands up already. Maybe we can start with you, Ms. Olivier.
Thank you for the panel members. I think there's a lot of, we're tiptoeing around this whole matter. Can you guys give us a solution if NAMFISA is to be adamant to say that we're taking risk benefits out? What do you propose we do for the member to make it beneficial for them?
Good question. Shall I come to you, Mr. Fabianus?
I think I can come in.
Mm-hmm.
I think what will have to happen is that each and every employer will have to consider whether they would like to continue providing that benefit. I think they should, because I think we've just had statistics about what an important role it plays in society. But how to do that, one way would be to say that they obviously take it out at the rules of the fund. That's probably the easiest. I think that's probably what NAMFISA would like to see, as unfortunate as it is. If they, however, would like to keep it in the fund, one will have to differentiate. I think I've made the point that this disability is very difficult to define in the rules. I think the trustees will, if you consider the requirement that trustees must not abdicate responsibility, which means that they must then define disability conditions and terms in the rules, it's going to be very, very difficult. There's another benefit called dread disease. I think it's also going to be very difficult to include it in the rules, because dread disease is defined normally by insurance companies, and there are different types of dread diseases. And pension fund, I think, is in the business of just providing retirement benefits. So to expect the trustees of pension funds to be the ones to identify the different types of dread diseases and define them and try and point them out is going to be very difficult. So to my mind, it will also make sense to rather take out an unapproved scheme outside the fund rules. Funeral, in the event of funeral, I think, and luckily, we have a tax expert here. The way how I understand it is that in a provident fund, you can have a funeral benefit covering only the member, but you can't extend that benefit to dependents, okay, if it's a provident fund. Maybe in a pension fund you can still do that, but in a provident fund you can't. So death is probably the only one that I would say it may be worth retaining in the fund. But now you will obviously then have to consider some of the provisions that can lead to a member not receiving a death benefit, such as, for example, if a member, what insurers typically do, where you do make use of an insurer, and you will have to, because I think otherwise the risk is too much that you will have to take on in yourself. The insurers normally have what they call a free cover limit. If the benefit exceeds a certain amount in a group setup, then a person needs to provide proof of their good health. Now, the NAMFISA doesn't want you to use free cover limit as a reason for not paying out a certain portion. They want you to pay everything that is defined in the rules. Yeah. So maybe the fund can then see if it can enter into an arrangement, maybe with the employer, to either then be prepared to assume some responsibilities in the event that there's anything at all that the fund is unable to claim from the insurer, if the employer is prepared to take that risk. Alternatively, the fund will have to then see if it can build up some reserves, so that in the few instances where a fund may not be able to fully recover an amount from an insurance company, that those reserves then stand in. Yeah. So it would seem, unfortunately, that the funds may be required to take on more risk than they have had to do so far.
There's a quick question from somebody who's watching us on the social media platforms. This is the question. What are we doing in this situation that we are in? Legally, the stance remains as per Gail's introduction. The only thing we have in writing is legislation and the directive, but it's not really saying that risk benefits should be clearly defined and form part and parcel of your fund rules. On the other hand, the industry have been attending meetings with NAMFISA and they know a bit more than the outsiders, meaning that they know this directive is directed at risk benefits and that NAMFISA has a specific intention with the directive and it is not necessarily contained from the face of the directive. So there's commentary, and then what are we doing about the situation we're in? I think we've heard about some interventions being planned by the industry to lobby, to advocate for some conversations to happen. There was another hand that was up, unless, yes, you can please proceed to ask your question. Thank you, sir.
Thank you so much. Mine will just add to that comment as well. So from the discussions, very insightful discussions, by the way, thank you for that. From the discussions we just had, it's very evident that no one wins. From an employer perspective, or let's start from a retirement fund perspective, they would have to move these risk benefits out. So the member is obviously disadvantaged from that perspective. From an employer perspective, he not only takes on additional administration, which the insurer, which the retirement fund previously had, they now have to, like Mr. Fabian has alluded, have to take on potential additional risk as an employer. So to that end, I do not foresee a lot of employers willing to do that. So they would probably do away with the risk benefits rather, and then again, the member loses. On the other end, if this is outside of the scheme, outside of the retirement benefit, and it's paid as an unapproved, it's viewed as a fringe benefit. Again, the member pays tax. So how the member loses all the way, how aggressively, perhaps to Mr. Sitwell, are you guys driving this agenda through the FEMA, maybe perhaps through the FEMA Technical Committee, because I know you have a sitting there, to really have some sort of resolution around this? Because we sort of need to have some sort of agency around this as well, because it's been out in the market for a while and we are not getting to a stage where it's where we are as an industry getting a solution. In fact, what's happening in the industry is we are feeling the impact already, where members are already starting to be disadvantaged because we are implementing the same. Thank you.
Cyril?
So when we did our round of consultations on the standards and regulations, this provision was not part of, was not introduced as part of the standards yet. We made our submissions to NAMFISA and we received commentary on a portion of what was accepted. At the meeting of last week, they then introduced that exact section of 11D that says members should know what would entitle them to the benefit. So this is now actually the time that we are going to consult, gain the input from the industry, because as the industry body, we can only advocate what our members want us to advocate. So once we have that mandate, we will then ensure that submissions are made, meetings are set up, and that discussions take place at the relevant forums.
Another question? Any other questions in the room? Yes, Ramon? And then I see the lady to my left. 2 questions.
Thank you very much. My name is Ramon. I have a comment and then a question. I think the comment is with regard to the unintended consequences of the directive. The fact that members are adversely affected, you're going to be out of pocket in terms of the additional fringe tax. It might be that your employer now makes a different decision. I think the only other comment I want to add to that is you also have this issue where your fund credit, when a member dies, there is a board of trustees that sit to allocate your benefit to beneficiaries. And there's a governance process around that. If employers, for instance, decide, look, we don't want to split payments because now we have savings and percentage of employer contributions towards death that goes, to the fund, and then there's insurance premium that needs to go to the insurance. Why don't we keep insurance and savings? It means that umbrella of governance is also removed for the member, because on the employer side, if the death benefit then lies with the employer in an employer policy, that money would be paid out as the member would probably specify and say 100% to my spouse, and there's no regard for potential other beneficiaries, which is the governance that pension funds bring. My question is, because I think the positiveness of the controversy with regard to mandatory preservation has raised the level of engagement of members. I want to know whether, from an insurance as well as a fund perspective, why are we careful to access the very people that are being affected to help us to lobby in terms of what we believe is really for their benefit? So I would just like to know.
Such an interesting question, Gail.
I don't think we're cautious. I just don't think we take the steps in order to engage with members. It's sort of members become aware of things after the fact or through media. You mentioned the preservation regulation. Sitwell and I were talking about that. That regulation was out there when FEMA started. And we had already, at that point in time, when we had the first engagements with NAMFISA, said to them, this is going to be problematic, the way that you've worded it. And they actually withdrew it until recently, when they slipped it back in. And I'm saying it slipped it back in because most of us were sort of, where did this come from all of a sudden? And was it not for media coverage and social media that actually got more of traction going, NAMFISA would not have had the stance that they had. We would have still just only seen it in the consultations on the standards and regulations. I think you've got a very valid point that we need, like Fabiana says, lobby is probably the right word, the right people who are affected by this. And funds should actively go out and actually tell members what's the effect of certain directives on their own pockets and how it needs to be handled by employers so that they can have a say. So it's not only the industry players like the consultants and the insurers and the asset consultants involved in this.
As they say in communication, you must provide light and not heat. And I think this morning, with the energy that we are displaying in this room, we're providing light, not heat. Any other question? I don't think it's, okay, it's on. Yes.
Is it on?
Yes, now.
Thank you to the panel for an informative discussion. What I haven't really heard is a potential legal resolution to this matter. I did hear Martina sort of briefly touch on potentially asking NAMFISA to change the law. But other than that, I'm not really hearing any legal resolutions. Am I to infer from that that all of the legal eagles are agreeing with NAMFISA's interpretation of Section 11D? Is that correct? Is that what we are to infer? And if so, how did the problem come about? Was there an initial misinterpretation of this section when it's been allowed now for 30 odd years?
I think Gail highlighted the backstory, so maybe you can just repeat that, Gail, and then I'll come to you, Sidwell, also for a response to her question about what's being done.
I think from the conversation, we've actually touched on a lot of what, if you look at the bare bones of the directive, it reads as if this is purely just getting members to understand what their benefits really are in a fund, and Section 11 actually allows or requires funds to actually stipulate that. But I think Fabianus is right that there is a further story to this, that it does relate to how risk benefits are being managed in a fund, and that needs to be unpacked with the funds. I don't think we're at the point to say that there aren't any other legal resolutions around this. We are at the stage of where a directive is issued and a directive is not legislated. Steps that the fund should be taking, it's directive, it's recommendation of how you need to handle it. I know the problem now becomes if you don't fix it in the rules, they don't approve any of your rules, which is another position that I think industry needs to start taking a stance on, that previously approved rules cannot now simply just by the stroke of one sentence, one person be deemed as invalid, should never have been applied 20 years ago or 15 years ago. There needs to be a hardest legal stance, and I don't think the industry has actually gotten to that point yet. And unfortunately, there needs to be either a group that decides we are going to take this further, or one fund that decides this is now going to require either mediation as a formal legal process or a court process that needs to happen. But I don't think we're at the end of saying that this must happen now, and there is no resolution except to go unapproved.
Yeah, no, I'm afraid, and I'm not a lawyer or legal eagle, but I think this is for even a layperson. It's as simple as that. If NAMFISA refuse to approve your rules because you don't comply with their expectations of their interpretations, then that's what it is. And I think many of us in the industry have the experience throughout the whole of 2021. We've been submitting rules, then they are declined, then you reword them in the hope that you make it clearer and satisfy NAMFISA's expectations. They were still declined until later, eventually you received a letter that told you that you now have 7 days in which you need to satisfy NAMFISA expectations, or otherwise the rules are declined, and then eventually they were declined. So I've indicated it, and I'm just going to take the risk of repeating myself. NAMFISA has to be part of the solution. And the only way is NAMFISA, who is the advisor to the policymaker, which is the minister, will have to realize the importance of this benefit and having it in the rules, because there's way too much at stake. It's the entire industry that is at stake. The insurance industry, I'm sure, will be at its knees if the direction in which NAMFISA is forcing the industry to go, if eventually everybody goes in that direction without kicking up a fight. There would be a lot of employers that will have to ask themselves, is it really worth it for me to maintain this cover outside, or should I just tell every one of my employees, you know what, go and take out an insurance policy? Yet we know it is cheaper to have group insurance than it is to have individual insurance cover. So I think we are already there. Sedwill and the rest of us who are in the industry, either we do something now, and it doesn't help, we just say we need to do something. Something needs to be done. Now, who's going to do it? There are some pension funds that have tried to take on NAMFISA on some other interpretations, because this is an issue of interpretation. And NAMFISA, obviously being almost a law unto themselves, will just frustrate you. I mean, which individual pension fund has got resources to be able to take on the mighty NAMFISA until the cows come home? You know? So no one has got a bottomless pit of money to do that. The only way it's really if industry stands together. And the industry has been divided, and it's been extremely difficult to get everybody to rally behind those that are serious about challenging NAMFISA. And everyone has been thinking that maybe someone is going to do something, and no one has been doing anything. So that is the problem that we have here.
The message is clear if you're listening to the people in the room. I think there's a clear mandate. I think at least there's a clear mandate. I think there is a clear directive, if I listen to the panel over here, as to how to move this forward. And I'm trying to get some roundup conclusions. So let me start with you, Johan. If you would just give us your final thoughts on this matter as we conclude this conversation, then I'll come to you, Sidwell.
No, I think, as was said now, I think for the industry to stand together, that's the only way we're going to resolve. Namibian companies like to not work together because everybody has their competitive advantage over the next one, and in the end, everybody suffers. And when you try to take on government, whether it be the tax authority or NAMFISA, or I think a lot of people are afraid of being retaliated against, and that causes them to not address the issue. I think that needs to change so that when the industry approaches somebody, there's a lot more that there's a stronger voice towards it. We saw with the introduction of withholding tax on dividends for local residents that the banking industry and the unit trust fund managers, they all stood together, and this was postponed now because the industry demonstrated to the ministry, listen, if you bring in this is going to be the effect on the people, on the Namibian people. So yeah, as an industry, I think as an industry body, there's a lot of responsibility to make sure that the members are protected.
Yes, and not only responsibility, but also working on. So I think, yeah, from Retirement Funds Institute side, we are there to support the industry. So we have sent out a round to solicit comments on the way forward, which we will then just reignite in order to take it further. We've heard the cries in the room. We've heard the talks on the ground. So from the Institute side, I think we know what our marching orders are, and we need to carry out the mandate.
Any burning 30 seconds submission you'd like to make?
I think I have made my point really, but I think it's also an issue of basically educating the members, the activists, the lawmakers. I mean, the issue of compulsory preservation was maybe simpler to understand for people to take a personal stand because they could see how it affects them personally. This is not any different, although everyone seems to think that they will probably live until retirement. It may unfortunately not be the case, and maybe if you survive until retirement, maybe your colleague or someone else you know may not, and it will be unfortunate if this law or the way how things are going were to eventually be to the disadvantage of the person you know or the society as a whole. So we need to educate everybody so that they understand what's about to happen before it is too late.
Thank you. Gail, 30 seconds.
Yeah, I was just thinking that going back to partnering well with the regulator, finding the solutions and crafting a plan. So if the one action doesn't actually happen, whether it's through RIFIN or a group of funds that have decided that they will actually action this, that it's clear what's the next step, what's the next thing that's going to happen if A falls down, what's B, who's going to action this. It can't be sort of a, let's have an engagement and then we get a response and then nothing happens for another 6 months. Have another engagement, nothing happens, and then we're 3 years down the line. It needs to be a concerted effort coming either from RIFIN or from industry players that are very concerned about this, and craft a proper plan around this.
Excellent. On that note, ladies and gentlemen, would you warmly applaud and thank our panel? I think they've done justice to their assignment. So thank you very much. You're free to take your seats back at your table. On that note, I'd like to hand over to Carmen. Carmen will come and conclude this event for us in a vote of thanks, and then after that we will invite you to breakfast, which I'm sure you're all excited to be having soon. So let me just here, while I'm here, just say thank you for the privilege of hosting you this morning, or being your Master of Ceremonies and the moderator. Thank you very much. I enjoyed this thoroughly.
rather be talking about lunch than breakfast. Thank you for staying so long. I think it was testament to the quality of the presentation and discussion that all of you have stayed, so thank you very much. So I'll try not to take up too much more of your time, just in terms of my vote of thanks, but that is actually quite an important part of today, so if you could just allow me a few more minutes of your time. So I trust that you found our time together this morning to be fruitful, informative, and a thought-provoking experience. Old Mutual is planning to host more engagements of this sort in future, as we believe that they provide a useful platform to learn and share ideas about some of the key issues that our industry is facing. This summit began with an excellent presentation by Louis Rousseau that provided useful insights on the past, present, and anticipated future impact of COVID-19 on our industry. Hopefully not too many of you are stunned and scared by that. I've heard some people are planning to get rid of their pets. Please don't do so. Louis' gripping presentation was followed by a panel discussion, which has just ended, that focused on the challenges that we are currently grappling with in interpreting and implementing NAMFISA's directive pertaining to the terms and conditions related to benefits offered by retirement funds. I'd like to thank our panelists, and I'd like you to please come up to receive a small gift from us. Gail, Sidwell, Martinez, and Johan. I see Martinez is holding back after the comments about him showing off. Thank you so much for taking time out of your busy schedules to prepare for the panel discussion and to share your thoughts with us this morning. We have certainly benefited from the insights that you've shared. Thank you. Thank you. You can ask your tax consultant for advice on that, Johan. Okay. And then, very importantly, to Hilda, a big thank you to you for being, as usual, an amazing MC and panel discussion facilitator. When I hear that Hilda's involved in the panel discussion, I know it's going to be a good one. We really appreciate that you always make time available to add or to make a positive contribution to our industry. So thank you very, very much, Hilda. Just a small gift for you too. So this Risk Summit would also not have been possible were it not for a dedicated team of Old Mutual staff who worked tirelessly to produce the excellent event that was hosted today. Maybe I can ask them to stand up as I announce their names. Because although there are a number of contributors, there are a few people that I'd like to especially mention. Isaac Vey, who's already standing. Aldrich Wallenstein. Where's Aldrich? Has he disappeared? Is he outside? Okay. Fabio Dorigo. Is Fabio around? Thank you, Fabio. Justina Hamepembe. Is she here? Thank you, Justina. Mwishitya Shininga Yamwe. I think I should get an award for pronouncing her name. I think Mwishitya is also outside. For those of you who don't, that name doesn't ring a bell, you might know her as Sarah. Okay, Cynthia Ketchiviri. She's also outside. Okay. And Lemu Sibanda. Thank you, Lemu. And then last but not least, the country club's Elroy Kluter. I assume he's busy sorting things out. Thank you to all of you. Finally, I'd like to thank you, our valued guests, those who attended this event here at the country club, as well as those who attended online. Thank you for joining us today. Old Mutual looks forward to engaging more on this topic with you as we collectively craft meaningful and sustainable solutions for our clients. Please note the Mutual branded items, not the country club things, please. The Mutual branded items in front of you are for your benefit. You're welcome to take them home as a reminder of this morning. And all that remains for me is to wish you a blessed day further, and that you'll enjoy the breakfast/brunch/lunch. All right. Thank you. Bye.